If you build trading algorithms, well, your biggest existential threat actually isn't a bad signal. It's the mathematical fantasy hiding inside your risk model.
Right, because standard frameworks, whether you're using value at risk or the Kelly criterion, they quietly assume your returns follow this predictable, neat bell curve.
Which we know they don't.
Yeah.
Real financial data is notorious for fat tails, like those violent, unexpected crashes that just completely break parametric assumptions.
Yeah, exactly. Those traditional models force this theoretical shape onto a really messy reality. And when the market inevitably violates that shape, you are completely exposed.
Right.
So that's exactly why conformal prediction is gaining so much traction in algorithmic trading right now. It provides guaranteed coverage, meaning statistically valid prediction intervals, without assuming your data follows a Gaussian distribution, or really any distribution at all.
Which is wild. But to pull that off, we have to build a risk metric strictly from the raw data. Right?
Yeah, purely empirical.
And the core mechanism here for this deep dive is the nonconformity score. Which sounds super complex, but it basically just measures absolute error, like how far off a model's prediction was from the actual outcome.
Think of it as ranking strangeness. So if you want a 90% prediction interval, conformal prediction just looks at your historical data, and it scores every single data point on how strange or non-conforming it is relative to the rest.
Okay.
And then it just draws the boundary right at the 90th percentile of that strangeness.
I love the analogy we have for this. It's like a bouncer at a club who doesn't actually enforce a strict pre-written dress code.
Right. No Gaussian dress code.
Exactly. Instead of saying, everyone must wear a tie, the bouncer just looks at the crowd already inside, measures how out of place a new arrival looks compared to that specific crowd, and then makes a decision based purely on current reality.
Yeah, the bouncer isn't assuming anything about the fundamental nature of clubgoers, just measuring reality as it stands right in that moment.
But wait, like a nightclub crowd might be static for a few hours? Financial markets are entirely non-exchangeable? The chronological order of events matters heavily.
Oh, absolutely.
You've got regime shifts, volatility clustering, calm periods suddenly violently snapping into chaos. So if our bouncer calibrated what is quote-unquote normal during a flat market in 2017.
That baseline becomes dangerously useless during a crash in 2020.
Right. So how do we fix that?
Well, the baseline utterly fails if it remains static. So to survive those distribution shifts, trading systems use a variant called adaptive conformal inference, or ACI.
Okay.
ACI treats the target error rate not as a fixed number, but as a dynamic variable that updates online by actively tracking an error sequence.
Meaning it mathematically penalizes itself for being wrong.
Yes, exactly. If the true market outcome falls outside your interval, ACI detects that miscoverage, and it instantly increases an internal penalty.
Yeah, wow.
Yeah, and this penalty artificially lowers your target error rate for the next step, which forces the algorithm to cast a wider net.
Right. And once the intervals successfully capture the outcomes again, I'm guessing the penalty decays.
You got it. It decays, the intervals tighten back up. It basically guarantees long-run coverage despite sudden volatility spikes.
Let's translate that dynamic net into actual portfolio sizing, because that's what you care about when you're trading. The research highlights two main applications: inverse width sizing and the edge ratio.
Yeah, so inverse width sizing uses the actual physical width of that ACI interval to dictate your capital allocation.
Makes sense.
When the interval widens due to, say, recent market chaos, your uncertainty is high, so the algorithm automatically scales down your position size. And as the market stabilizes and the interval narrows, it sizes back up.
And then the edge ratio kind of acts as the circuit breaker. You take the expected return of your model and divide it by the width of that conformal interval.
Exactly.
So if the interval is massively wide, meaning it easily straddles zero, that ratio just plummets. It's a mathematical filter telling you the uncertainty is way too high to justify the trade.
Right. It keeps you out of markets where the noise just completely drowns out your signal.
Okay, so if we have this highly responsive, mathematically sound interval, a trader's first instinct is going to be, well, let's plug this straight into the Kelly criterion to optimize growth, like a conformal Kelly hybrid.
Oh, yeah. And the research strongly warns against doing that.
Really? Why?
Because the Kelly formula mathematically requires you to know the exact probability of winning and the exact shape of your payoff distribution. But conformal prediction strictly guarantees the outer boundaries of your risk. It deliberately tells you nothing about how returns are distributed inside those boundaries.
Ah, because conformal prediction is distribution-free. So if you bolt it onto Kelly, you're secretly reintroducing assumptions about what's happening inside that interval.
Exactly. Which means you're pretending to have more information than you actually do. That leads you to double count your edge and drastically overallocate capital. It's a trap.
Got it. So the ultimate value for your algorithmic trading is that conformal prediction provides a truly honest assessment of risk. I mean, it eliminates the existential threat of parametric model risk because it never forces the market into a preconceived shape.
It grounds your risk management in pure empirical reality, and it actively adapts as that reality changes.
It does force a fundamental shift in perspective, though. Since conformal prediction strictly defines the limits of what you can know, leaving the interior of that interval a complete black box, well, here is something for you to think about. How might you redesign your core trading strategy if you truly accept that what happens between your risk bounds is entirely unknowable?